Fitbit is stepping up the pace. Get it? Yesterday, the fitness wearables maker raised its IPO target to $17 to $19 a share, meaning it hopes to raise as much as $650 million in this offering, which prices tonight. Fitbit shares will start trading tomorrow. We're taking a closer look at Fitbit with the CEO and co-founder of Triton Research, Rett Wallace. Does some great work on private companies pre-IPO. You've brought your deck. I love it. This is what you do on Fitbit.
We do. This is everything you need to know about Fitbit, all between two covers.
So people are trying to decide right now.
They already decided.
They already decided whether to get the allocation. What they're also trying to decide is whether to buy, right, in the secondary market tomorrow. What do they need to know about Fitbit in the context of wearables, consumer electronics?
Two ways to think about, do I want to buy the stock? The first is supply and demand. Is the stock going to go up? And the second is it a good company? We focus on the latter, which is it a good company? So Fitbit scored a 7.58.
Do you focus on that anymore?
It depends. Our clients do, right? And so we think that the fundamentals, even for companies like this that grow as if by magic, there are actually catalysts that cause a company to grow.
7.5 on a scale of 10.
So 7.58 is our second highest score of the year after Shopify, and it's a big deal, right? So it's raising over $500 million. It's got over $1 billion in sales, right? But much more interestingly, the model for this company shows that their customer acquisition characteristics continue to be really favorable, which suggests that the company will continue to grow.
Let's bring up that chart, actually. So this is devices sold, which shows you that it's a rocket ship to the moon.
Right.
Now let's bring up the customer acquisition chart, because that is...
We'll preempt and say that basically what it shows is that Fitbit can continue to spend money to acquire customers at a reasonable price. Sometimes customers hit what we call diminishing returns, where your next marginal customer costs a lot more than your last one. Fitbit has not experienced that. This is one of the things...
They're not throwing good money after bad.
They are not. So this is one of the things that happens when you have a category-defining brand, like Fitbit does, right? It's a Fitbit, like it's an Uber, like it's a GoPro. I got a Fitbit on.
You do.
Now, is there a difference between a Fitbit and a Jawbone? They look different. Are they really different? I don't know, but these guys have a brand.
And you think it's going to be a long-term buy? I sort of feel like the risk with Fitbit is tons of people buy them once. It's a perfect gift for someone, and it's a perfect price point. But long-term, are people really connected to this world of connected fitness?
So our models show that even in our downside case, through 2017, you have good growth and good profitability. Like, this isn't a company that you're waiting for some inflection point later to get to profitability. Like, again, our downside models, and we torture the models based on the real fundamentals, show that this company makes money, to the tune of like mid-teens EBITDA, even in a downside scenario.
Okay, well, this is, your research is much more sophisticated than mine, but I did a little bit just to show everybody where Fitbit ranks against other wearable companies, and there aren't that many.
Right.
But it's growing faster than anything else, right?
Yes.
Garmin, Casio, GoPro. This is EBITDA, right? EBITDA margin. Garmin has a great EBITDA margin, but Fitbit's is way better. Look at these other companies: Casio, GoPro, Skullcandy. Revenue growth 175%, and it's not a brand new company. It's been in business for a few years, and very competitive on the gross margin. Let's bring up that chart too, right? They've already figured out how to manufacture efficiently.
Here's another thing that I think is an interesting thing to consider. You see Spotify, a company that's never going to make money ever, no matter what it does, raised $500 million in the private market very recently. These guys are raising money in the public market, which just shows...
But they couldn't raise money in the private market 6 months ago.
I expect they could in this market, and they're going public because this is a company that's ready to be public. It actually makes sense for this company to be public.
Rett, thank you. Great stuff. Rett Wallace, he is the CEO and co-founder of Triton Research. Fitbit is pricing tonight.